So Supriya, you did the cover story, right? Glass half empty. So what actually led you to write this piece?
We wanted to take a more comprehensive look on how the companies in Bursa Malaysia, how they fared, because analysts had come up with their own assessment of how the companies had fared, but that is actually based on their universe of companies. So we wanted to take a more comprehensive look. So what we did was we looked at the 800, I think over 800 companies on Bursa Malaysia this year, compared them to their performance last year, and we also looked at last year compared to the year before, how the companies had performed. And what we actually found was companies, like 49% of companies actually reported better earnings, and last year the number was 41%. So we wanted just to have that more comprehensive view. That was the main reason for doing this story.
So this was for the first quarter, right?
Yes.
So when it comes to poor earnings, I mean, we've seen really bad earnings before, we've seen really bad quarters before, but why were the recent numbers this time were particularly worrying?
One aspect was this trade war. Of course, the trade war isn't exactly something new this year. It was spoken about last year as well. But this year, I think it's a matter of how aggravated this trade war has become. It's no more like people are not talking about it as it's something's going to happen. It's actually already happened.
Yeah.
It's slowly, and it's going to get worse. So that's why we wanted to see how, and corporates are also like, they're cognizant of this, because if you look at their quarterly reports, you look at the prospects part of it, they're all talking about the trade war and the uncertainties that the trade war brings. So this is why we actually wanted to look at how badly corporates were affected by the trade war, and we found that, you know, for some sectors they were impacted, like the tech sector, the steel sector.
So, the first quarter wasn't actually as bad as some people feared, but still, this did not lift the stock market. So, were the external issues this time were just too overwhelming?
I would believe so, because if you recall, in mid of May, the CI actually fell below the 1,600 level. So people were attributing that to the trade war as well. And I mean, why we also use that glass half glass half empty analogy is because the market is sort of already priced in this. Even if the earnings had slightly improved this time around, the market has already priced in. People were looking forward to a very bad quarter this year. None of the analysts was saying that it's going to be a fantastic quarter. Earnings are supposed to beat expectations. People were already pricing in a very slow quarter, and I think that's why the market also did not perform up to par.
And so, looking at the industries, right, these companies, auto, energy, and consumer actually did pretty well last quarter, but it was a different story for steel, plantation, and tech. So, do you think that this pattern will continue?
For the auto sector, it's a bit easier to gauge because they did phenomenally well this quarter. And if you look at the second quarter, we had the Hari Raya celebration, so a lot of auto companies were having promotions. And also, like if you look at a company like DRB Highcom, the X70 is doing very well, so that's why you would see that auto earnings seem to be quite stable, and analysts also have been quite positive about the auto sector. Same goes for consumer sector. The Hari Raya festivities, there were a lot of buying, and with Bank Negara cutting the OPR in the second quarter, that would also help boost the auto sector and also consumer sector, because people have more disposable income in there to spend, so that kind of thing may continue. But for energy, it's a bit of a wild card, because it would have to look at where the crude oil prices are. Nobody can really predict crude oil prices because it's been really fairly unstable. It was at $80 in October last year, and now it's at 60, and it was at 50 in the beginning of last year, so it's not really that easy to predict. But if oil prices continue to stay where they are and they improve slightly, then we could see energy companies doing better as well. And you also have to remember that energy companies in the second quarter of last year, they did not fare as well. So coming from that low base, any slight improvement in energy earnings is good for the energy sector as well.
Okay. So trade wars and all manner of economic issues, will the glass ever be back to being half full?
Whether we could actually see the glass half full analogy back again, I guess it would go back to the trade war. From what we've been reading and what we've been hearing coming out from the US and China, it seems like it's not it's not improving. It seems like more threats are being made.
Yeah.
So it would probably depend on what happens, what's the outcome of that. I understand that they're meeting at the G20 summit. So if something positive can happen out of that, and taking the cue from what happened between US and Mexico, they've actually come to some sort of trade agreement. So hopefully we could see the same for the US and China. So that's just one aspect. And in another way to look at it is if commodity prices actually improve, if they actually bounce back, then that could also be good for companies of Bursa Malaysia, because we've seen CPO prices have fallen drastically, and that's taken a hit on plantation earnings. And if that can improve, then that could probably improve the prospects, and we could probably see a glass half full situation back again. And also looking at the ringgit, another portion is, if you look at a weak ringgit, it's actually good for our exporters, it's good for tourism dollars. So we probably would see some companies in that line doing well. So then we could actually look at positives of having a weaker ringgit. Yeah, and also if on weaker commodity prices, perhaps it could benefit the logistics, the transportation sector. Yeah.
For more on the stories, pick up a copy of The Age Weekly at all good newsstands.